Bob Pisani on the floor of the New York Stock Exchange. Hello, Facebook fans, Twitter, YouTube, and hello, Instagram fans as well. Always a pleasure to see everybody. I'm here on the balcony. There is the where they ring the opening and closing bell right behind me. My 22nd year here at the New York Stock Exchange, and everybody wrote in and wanted to know what's going on with the IPO business. So we'll talk about that a little bit today. Everybody seems to be asking me what happened to Lyft, or did Lyft misprice or something like that. Lyft has a number of issues. The most important thing about it is they lose money on almost every ride. So think about it. I don't know if a lot of you people travel around in Uber or Lyft, but the situation is pretty similar. They lose money on most trips. Why do they lose money? Well, because they're trying to establish a global presence in a business that never really existed in a significant way before. I mean, obviously there were ride-hailing services, but not like this. Not one that's really truly a tech company and not really a ride company. So that was the first issue. They make about $2 billion a year in revenues, but they lose $1 billion a year. That's an awful lot. And look, a lot of companies go public and they're not profitable. That happens all of the time. But eventually, this happened at the end of the 90s, people tire of no profitability because, after all, the stock market is supposed to be a play on a future stream of earnings. No earnings, eventually, promises, investors start getting tired and they abandon you. This happened big time with the first wave of internet stocks. We only remember the winners, like Microsoft. You don't remember a lot of the losers, like, say, Pets.com, maybe. So that's what the biggest problem. Now, Uber has a similar problem. They have $11 billion in revenues and $3 billion in losses. So Lyft, $2 billion in revenues, $1 billion in losses. Uber, $11 billion in revenue, $3 billion. Still big losses, but the revenue base is a lot bigger, and the path to profitability may or may not be a little quicker than it is with Lyft. So that's first problem, losing money. Second problem is the pricing was a little bit iffy. These are very hard to price and figure out. It's hard because you're dealing with a company that doesn't have a lot of comparables. There is no other Lyft that's out there. You could try to do other companies, but there's nothing like Lyft ride-hailing service that quite is there. So how do you price it? Well, often you look at how the last round of funding, private funding, went. And Lyft's last round of funding, between that and how they actually priced it, was 50% higher. Now, the last round of funding was a year and a half ago, but pricing at 50% higher, that's pretty aggressive when you've got still big losses coming down the pike. And there's some question about how fast you're going to grow at this point, whether or not your growth is peaking or not. So that was a major problem. So if you ask me what happened with Lyft, I would say, number one, there's the losses, the big losses. And number two, there's the question about how they actually figured out pricing. There was some disputes about whether some people who were supposedly locked up were trying to short the stock. I don't know the answer to that. There may be some legal issues involved there. But I tend to think, given the problems with the valuation, the pricing, and the losses, that may have been a fairly small issue. Laura, what else?
So you just talked about Lyft. What can we expect from Uber? Same story.
Okay.
And when are they likely to go public?
Okay, Uber, what's going to happen? So it is likely we will hear from Uber perhaps this Friday, but certainly next week. This is not a set thing, but by and large, within a couple of weeks after them essentially announcing that they're prepared to go public, you'll hear something from them. You will hear about some kind of pricing range. You'll hear about shares floated. So we'll say we have X number of shares we'd like to sell to the public at some indicative range. Pick a number. Between $19 and $24. That's not the number they'll use, but that's typically the range that you'll see, something like that. And then they'll announce they're going on a roadshow. The roadshow means we're going to go out to the potential investors, either typically mutual funds or venture capital firms or hedge funds, and make a presentation to them about what's involved. They'll put out what's called an S1, where they'll explain gigantic, usually 300 or 400 page document explaining in great detail what the company does. This is a big thing. Essentially, they're giving away a lot of their secrets. And this is part of the problem with going public. Why am I giving out all this information to our competitors to tell everybody what's going on? Well, it's a requirement because the SEC wants you, if you're investing in them, to know what you're investing in. And the legal way to do that is through what's called the S1 that has all of the disclosures. It has all the risks. It has generally how much money they're making. And it's a big risk for a company to expose all of that information. The hope, of course, is that the IPO will do well. So I am anticipating, certainly within the next week, we'll hear from them. As for when they might go public, I think the chances are pretty good that they'll go public sometime in May. Laura?
So you already touched on this a little bit, but what are some of the downsides to going public, and why would it be in a company's best interest to remain private?
Yeah, so what's the downsides to going public, and is there any, does the company have any interest in staying private? And the answer is yes, it does. So the downside of going public is, number one, what I just mentioned. You're telling all of your competitors all about your company, essentially. It's a legal requirement to go public. So you're showing the family secrets. That's a major problem for a lot of companies. The other big problem that's out there for a company that goes public is all the regulatory requirements. It costs, depending on how big the company is, it costs tens of millions of dollars in legal fees to go public. You also have certain legal requirements from the CFO and the CEO about signing off on the financials. You could be subject to civil and criminal penalties if they're not accurate. So you sign that statement, you're not signing your life away. That's a bit of an exaggeration, but you're certainly putting yourself at legal risk if you're the CFO and the CEO of the company. The third issue is regulatory risk that's out there. There are tremendous amounts of regulatory burdens that you have required to follow when you go public. And a lot of people bitterly complain about this. For small companies, it may be really onerous. It may be so onerous, it's not worth it to go public. In terms of why people would stay private, well, number one of the reasons we have seen all of these so-called unicorns stay private for so long is that private companies, hedge funds, venture capital firms, private pools of capital have been throwing money at these tech startups, at Uber, at Lyft, at Airbnb, at Palantir, at Pinterest, throwing money at them and essentially saying, let us invest in you. And they bought up large parts of the company. Now, the company is sitting there saying, well, let's see. Other than having a coin for our employees to trade with, why should we go public? If XYZ Capital Fund offers us money to invest in the company, why should I take on all the other problems of going public with the regulatory burden and signing my life away that I could go to jail as the CEO if the financial statements are not accurate? The incentive is very high to stay private when you have a lot of private money sitting around you. Here's the problem and why this is happening this year. Those companies that gave them the money, the private venture capital firms, they have a business model too, and it doesn't involve sitting on the same company investment for 10 years with no return for it. That's a problem. Their model involves getting investment and then usually getting out in 3, 4, or 5 years. How do you get your money back? They're not supposed to sit on these things for 10 years, but they have been because it's a very lucrative opportunity, or at least they think so. So now you've got these companies. Here's the downside. All of you people want to invest. You're not buying some startup. Uber is not a startup. Pinterest is not a startup. They're not old companies, but they're certainly middle-aged companies. They're approaching middle age. Some of them, all of them in fact, have already seen their fastest growth. There's a lot of debate about whether Lyft is essentially peaking in terms of its growth right now. I mean, it's not that it's not growing, but whether it's increasing its growth rate. There's a lot of debate about that. So you're investing in companies that have already been around so long that they're already approaching middle age. That's the whole downside. That's why I've been so unhappy for years about this. Yes, if you would have gotten a company younger, some are going to fail, so you get more volatility because it's hard to pick the winners. This is what happened in the 90s. We all remember Microsoft. Nobody remembers Pets.com. But at least you get the chance to pick, and I would have rather taken the chance to pick over letting these companies stay into their maturity.
So, were the 90s more exciting than today? And what was the most exciting IPO you can remember?
Oh, the most exciting. Well, the 90s had some really wild ones, but I would say just recently, Twitter was really fun to see. Alibaba, Jack Ma, we were down here on the floor, and I was inside the Post. Jack Ma came into the Post and chatted with us. There was only 2 or 3 of us sitting there, and that was a lot of fun, just talking to him for a few minutes. And that's one of the great things about being the floor reporter. People say, gee, why have you been down here for 20 years, Bob? You get to meet people like that, and even unscheduled. It's not that I necessarily arrange all these interviews. They're there, and I come over, or they come over to me. In the case of Jack Ma, he came over to me while we were sitting in the booth, and the stock hadn't opened yet. So what's it worth to be alone with Jack Ma for 5 minutes, 7 minutes, 8 minutes, very short periods. These are not long discussions. Well, it's worth a lot. You have a lot of memories, and even if you're not sitting there doing something that's recorded publicly that everybody sees, a private conversation with Jack Ma can leave a pretty nice impression. I can tell you, 22 years on the floor, I got a lot of private memories of talking to some very, very famous people.
That's so exciting. Couple technical questions. Can anyone invest in an IPO before it hits the secondary market?
Okay. Can anyone invest in IPOs before it goes public? Generally, no. There is what's called a small secondary market. It's a private placement market, essentially, for IPOs. So if I'm at XYZ company, if I'm at Pinterest, for example, and Pinterest, this is before Pinterest went public, there are certain venues where I, as an employee, hold stock internally in Pinterest, might be able, under certain circumstances, to sell it to somebody else at some pre-agreed price. So there is a small marketplace for these to trade before they go public, but it's not terribly well organized. And I can't say, we don't quote the prices on it. I mean, I might be able to find out when somebody transacted something at a last price, but it's not widely done. So yes, there is a small market, nothing that is really quotable on any kind of regular basis. Got one more question here.
Sure, one more question, very similar. How do employees sell their company stock before an IPO?
Well, this is how they sell before the IPO. And again, most employees don't. And this is one of the reasons companies go public, because you've got 5,000 employees, and that small employee has no way to monetize that investment. So imagine this, you're at Pinterest, I'm just using them as an example, and you've been there almost since the beginning of Pinterest, and a significant part of your compensation has been in the form of stock. Well, now you're sitting on, pick a number, 5,000 shares of stock, and it was given to you at, pick a number, $3. I know that sounds crazy, but that often these internal insiders own these companies at a low single-digit prices, and you've got 10,000 shares of this stock at $3, and it's going to go public at 20, but maybe it's not going to go public. You're sitting on an asset and you want to buy a house. What are you going to do? You can't do anything because the thing is essentially locked up, and there really isn't much of a private market for this. I mentioned that. It does exist, but it's not very liquid. That's why these companies are, one of the reasons they're incentivized to go public, to allow a means of cashing out, or at least partly cashing out, by their employees. Anyhow, it's going to be a great week. I anticipate we'll have some numbers on Uber within a week, and of course we'll be down here reporting on all of that. I'm Bob Pisani, down on the floor of the New York Stock Exchange. Everybody have a healthy, happy, and safe trading day.
Thanks, Bob.
Thank you.
That was great.
I hope that helped.